high inflation or recession? That's a very tough choice for Fed to make right now. High inflation or recession? That's a very tough necessity for Fed to choose between, because they are not other alternatives. So there is a very hard nut to crack for the economy right now, when hiking interest rates by Fed may lead relentlessly to a possible bankruptcies and even collapses of some big companies and corporations. So what are the next steps for Fed to make, and when and where that will finally stop? Today I'd like to introduce you my point of view on what the issue. Will make a recap of what happened during recent 2 weeks, and as usual we'll just look through a crypto outlook and markets, but today's episode won't be end up with 3DDR section, as it will be a little bit longer episode, so I will focus on that tomorrow. So today, let's begin. So let's get to economy view, and heading from the confession made by Mr. Powell that soft landing very challenging. They were previously claiming that soft landing will occur, and right after that there is high probable that soft landing will make its place. Right now they're claiming that it's very challenging, the same as they were claiming about inflation 1 year ago. So we are at a very critical point where it looks like their credibility is starting to erode. Right now there is a high risk of breaking something. We can observe that on different times, different gauges. Let's get into business standard.com. There is Citi, first of the bank, that is observing different spectrum of gauges, and they see that recession nearing 50% due to Ukraine war, COVID, and other problems. So there are first banks, previously it was Nomura, right now it's Citi, that are pointing that there is more and more probability of the global problems and also recession in terms of GDP and gauges. So returning back to Fed, they will never admit that the problems are ahead of us, because they are responsible for getting us out of the problems, and they don't want to spread the panic around. So what Mr. Powell said, inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and evolving outlook. Yeah, they have tried to be nimble 1 year ago, and they didn't want to stop the inflation that was getting out of control. So we are in time of hiking interest rates, but will it be enough in order to get a confidence back to investors? Right now, the July's hiking interest rate should take us once again to another 75 basis point hike. But whether there are any signs that we may find that the situation is under control. Right now, the milk has spilled, and no one is able to take it back to the bottle. And eventually we notice that there are some signs that may lead to global growth slowdown. So at first, let's have a look here. US gasoline prices tumble ahead of Biden's tax relief plan. So tax relief plan is not maybe impacting the US gasoline prices as much as this exactly slowdown, and maybe just upcoming this quarter, and already been seen by this gauges on the market. So this prolonged decline, if it happened on US oil, that would ease probably inflationary pressures and help drivers struggling with record gasoline prices. So that's obviously something that we have expected. This a little bit slowdown and stabilizing of gasoline prices is necessary for the economy to get back to its trajectory. But unfortunately, after this major ride to the upside of oil, right now we need much bigger slump than it's just a correction. So, and in the history, whenever the US oil prices slumped, we right after observed a high correlation with a global economic slowdown. Also, PMI right now are steady, but are still trending lower, just hanging around the 50 points. So there's no technically a recession in terms of this gauge, because it's assumed that when dropping below 50ish, we'll get down to a recessive territory. But right now, this trend is nowhere near to a revert. We still need a rebound right from here within next at least 2 months. And there is another observation that these commodity currencies are trending lower since first quarter of 2021. So it means that slowdown is observed throughout more than a year now. So central banks always underestimate how quickly the core capital of a financial institution can dissolve into inexistence. We can observe that with this slowdown, there are more and more ventures that may go through hard time, and hiking interest rates to that extent might be good, but the problems are not around the monetary issues. The inflation doesn't stem from the monetary issues, but rather the supply problems, supply chains problem caused by whether it's COVID, whether it's war. So right now, private equities are going to have some heavy weather out of it, and we can find that there is also the deglobalization trend that already been started when Mrs. Yellen urges less dependence on other nations for key supplies, and claiming that US is enormously dependent on China for rare earths. It means that there is still much more pain to come in order to reorganize the structure of the economy before it eventually will get better. Maybe hiking interest rates won't make Fed unable to conduct their monetary policy. However, they may dissuade policymakers from selling mortgage-backed securities. So that may crack something on a housing market that already been weakening. US housing starts permits both dropped by more than forecast in May, and that also may strengthen on the road ahead. So that's the issue that also the policymakers need to take notice on. As of next one, we may observe that these supply chain problems are still the obstacle for recover. DHL warns supply chain won't recover to pre-COVID days in 2023. Conditions are improving, but it will take more time. We observed that within different indexes that we peaked in a third quarter of 2021, but still need to tackle that way to get to normal. So that's the things we need to also consider when making our assumptions regarding the future. Another case of this possible slowdown are these layoffs that are getting across banking structure. JP Morgan lays off hundreds in home lending after rate surge. So hundreds more to be reassigned as demand for home loans cools. So the one thing that may just point us that we are just very near to a possible housing slowdown is that there are lays off around this sector. Also, JPM is not the only one that is going through such problems. Wells Fargo recently, the biggest mortgage lender among US banks, has been laying off and reassigning employees in its home lending divisions. So there is maybe just a first sign that something is trying to break. So we are just going through the liquidity problems when it evaporates, and whether it's indexes, cryptos, stocks, everything is crashing down. Right now the high volatility and low liquidity is making a bloodbath on nearly every market, even including bonds. And here you have an insight into high-yield corporate bond ETFs that already been going through the biggest discount since March 2020. Pricing growth, European equities may already price in a significant economic slowdown. That's the observation made by also Bloomberg, that right now is the European equities are trading much lower than the all-time highs, and Eurozone composite PMI still haven't been declared as diminishing now. So with this one PMI start to revert to the downside, there might be much more pain to come. Let's have a look at trajectory of US leading economic index. That is consisted of elements in an analytic system designed to signal peaks and troughs in the business cycle. Right now, indexes are constructed right to summarize and reveal turning points in the economy. Right here, we can find that there might be a peak already being signified, and that can mean that the sluggish growth might be yet to come. Also, US LEI continued to moderate in May, but right now this drop is so heavy that we won't see a rebound possibly in next months ahead, as it's probably may long a little bit longer this reversal pattern. Another aspect of a slowdown stems to US factory output that surprises with first decline in 4 months, and also distillate fuel oil supply to US customers that also has diminished, and that is why systemic equity positioning is so low. That's on the date of 14th of June, but nothing has really changed since then, as the sentiment is so low. Estimated gains and losses among small options traders right now are just below and making a rock bottom right below the COVID-19's breakout lows. So there are right now more and more traders selling to a loss. The reduction of single stock positions by retail has been sharp, and looks like this. It means that around 50 and 25% of retail positions in Nasdaq 100 and S&P 500 single stocks respectively accumulated since January 2019 been sold. So there are no more fresh blood on the market, and the market is getting more and more competitive around algorithms and hedge funds. So that's very important to be well educated and also be very cautious in terms of taking any investments and investing approach. On the other hand, there are still some investors that are piling into US stocks, and they haven't really been discouraged by a recent US 500 performance. So right now it means that we haven't gone through a panicking mode when there is still some of the investors that are still waiting aside and claiming that firmly. Also, that something that may add up to some positivity is that CEO confidence is a good indication of EPS trends, and right now is showing that it's higher than it was before during the COVID crisis. So many of CEOs right now are pointing that the time will get okay, at least okay, and also we can find that down to this there is a buyback growth coming up, and is at one of the highest levels been ever noticed. So it may help the valuations in a near term. However, Goldman said to offer FX rates lasting days to ease hedging. Yeah, there is interesting chart where we are finding out that global currencies are the most volatile since early pandemic panic. So it's very interesting time to trade right now, as it's very good volatility. What we can find here is that strategists have lowered their return expectations for the S&P 500. They have expected in December that S&P 500 will hit in the next year at least 50,000 points. However, in June they are expecting this one to get to lower levels than it were pointing before at 4,600. Will it diminish once again? We'll find out in the future. Earnings forecasts and S&P 500 show unusual divergence. So right now we can find that earnings forecasts are still at the very high levels, and there is typically the only one thing that may push the valuations even lower is that dividends will lower earnings, expectations will eventually lower, or expansion of the PE multiple will get crushed. Will any of that happen and may get the valuations even lower? That's still possible. Another also finding that is showing us the diversion between GAAP earnings and PPI CPI is pointing that we still have some chance to get lower. Right now on GAAP earnings we are getting back to around 50%, and also PPI CPI spread is very high. That might be a kind of a presage of a oncoming recession. So at this point it's too late to panic, but maybe too early to buy. However, in commodities aspects, there is a very interesting chart where we can find that whenever commodities get to a satisfactory levels above 10 points in this fidelities rank, we may get through at least couple of years of a long-standing commodities high prices. Will it happen this time? That's also may come in. With this inflationary pressure, we still may have a commodities boom lasting longer than it's supposed. The question is when the recession will finally come. The average recession is getting us to an aggregately EPS getting lower by about 15%. So it means that for S&P 500 we may get lower down to around 3,200 points. So right now we are expecting that the recession, if it will finally happen. The days from down 20% to bottom will occur at around 4 to 6 months. So we will be bottoming for about the next of a year, but that's just an assumption regarding what the history told us. So that's interesting to watch. And we are heading to crypto outlook, and here we have a devastating rating where long-term holders are even panicking. The current bear market is now entering a phase aligned with the deepest and darkest phases of previous bears. Right now we are just getting purged from holder base. Also on the metrics of net realized profit and loss, we can find that there are so many wounded investors, wounded by their stupidity or their greed. So by stupidity and the greed, they're using a high leverage, and that's why that net losses are stemming, are like pointing to 4.23 billion dollars. Among them, there are also crypto hedge funds that already been also have stacked on this 100,000 per Bitcoin dollars assumption that has turned to be wrong. So recently, in the previous week, Bitcoin's leg down pushed the coin below 19,000 bucks, and the high it hit during its last bull cycle in 2017. Right now, throughout this 12-year trading history, Bitcoin hasn't really dropped below previous cycle peaks. So it means that there's returns of Bitcoin might be diminishing upon a time. What does it mean for investors? For investors, it means that no more moon possibly, just more like decent returns in the future possible, but I wouldn't find that Bitcoin will repeat what it had in the previous 10 years period when it gained more than 10,000 times in its peak. Also, we are seeing troubles in stablecoins side. Stablecoins are often relied upon by crypto traders to move funds around the ecosystem without needing to exit into traditional currencies. And right now, with this one slumping and following the curve of new emitted stablecoins, we may find that the dark clouds might be ahead of crypto sector. So more and more entrepreneurs from a crypto sector are on the underwater. Right now, high energy costs and capex commitments are pushing the valuations lower, and something that is also pushing off new investors to come into the sector. Bitcoin's realized price is pointing that we might be heading a bottom, but for this one to happen, we may still get a long time to get over it. So this March bottom was the only one event that has been so quick in its terms, and I wouldn't suspect this one to happen again. So the articles like this may occur more and more repeatedly. Miner Bitfarms sold almost half its Bitcoin to reduce debt, and that's something that we may see in the future. However, there's a light in the tunnel. Wall Street gets a short Bitcoin fund after 70% crypto collapse, and usually such types of funds are leading to a conclusion that the sentiment around the market is really, really low, and there might be a very good time to watch for possible long-term bets around the sector. Bitcoin market meltdown prompts fresh warning in China that the value of world's leading cryptocurrency could fall to zero. How we could interpret this? So literally in the past, whenever China was claiming that Bitcoin is going to zero, Bitcoin was has reverted its trajectory and showing us the relative strength. So it's first there are first few signs of Bitcoin bottom, but I would rather turn to a DCA, so it's dollar cost averaging every single investment. So we may grab some of the Bitcoin in terms of a long-term perspective right here on this recent bottom, and maybe also perhaps waiting for a little more slide in the future. And if it happens, there might be another occasion for us to buy. Bitcoin cost basis supply profile is showing that's been made by Economic, very known analyst, that is showing us that still we have many percent of coins in profit. Right now it's around 51%, and in the previous generational bottoms the reversal happened when the amount of these coins been left standing at amount 36 to 43%. So this one of an analysis pointing there is still room to drop. In terms of market mover section, we are getting through trading economics calendar, and during this week we already had Fed bargain speech from US retail sales that in Canada has slumped. That's the gauge been published on Tuesday, so that's showing us that sentiment in Canada is lowering. Right after we have existing home sales in US that is dropping, that already what we've been talking about. Right after we had on Wednesday inflation rate from Canada, and this one however has dropped, but in a year-over-year period it's still higher. The consensus was at 7.4%, actual is 7.7%, so inflation is speeding up, slowly but speeding up. Right over we had a Fed Chair Powell testimony that we also were introducing this from Euro area. We had a consumer confidence flash that once again was at a very low levels, and doesn't seems to revert anytime soon. Right over on Thursday we will see the Fed Chair Powell testimony once again, and we may find that initial jobless claims already been published. Initial jobless claims showing us that there is the market is very tight, and it means that there's another room for Fed to hike interest rates. However, a bit anxious is that this curve is starting to revert, and there might be kind of a presage for that may get worse with this recession. Spotlight will eventually come closer. On Friday we have retail sales from Great Britain and new home sales from US to watch especially. So that's it in today's episode. Thank you very much for watching, and I invite you to watch tomorrow's episode. They will be published right before the market open in US, so that you will have the most updated news right before taking any investments and trading decisions. Thank you very much. See you then.